Welcome to the 3-Edge Weekend Review for the week of April 28th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, the CEO and the Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I are going to discuss something that we haven't heard much about, but it's something that we are certainly keeping an eye on, and that is the possibility that the emerging tariff policies, potential for trade wars, could ultimately set off a tightening of financial conditions and even a credit crisis, which is sometimes referred to as a credit contraction or credit crunch, And that basically what it is, a situation where there's a sudden shortage, of the liquidity that keeps the economy and the financial markets functioning. And it can be caused by instability in the financial markets, an increase in loan defaults, or simply a loss of confidence in the banking system, among others. And during a credit contraction, banks and other financial institutions may be reluctant to lend, and that can decrease overall activity in the economy, and that could lead to layoffs, bankruptcies. So it's definitely not a good situation for either the economy or the market. So let's get going here. Let me bring Steve in. And so, Steve, maybe to start, because it is not an easy concept to necessarily grasp, if you could explain what exactly is a credit contraction and perhaps what in the current environment may be setting up for that eventuality.
Well, to use as an example, after COVID, we had an extraordinary loosening of financial conditions. We had unprecedented monetary policy stimulus. The Fed literally printed more money in a 3-year period than in the previous 107 years. Massive monetary stimulus. And that was followed by an unprecedented fiscal stimulus where the government issued trillions of dollars of fiscal stimulus, put money in people's pockets. So the combination was a massive loosening of financial conditions, all because there was such a fear that COVID would cause such a severe recession, and we try to fight that with all the stimulus. So now we have a very different situation. The Fed is on hold. They're afraid to add stimulus because they're afraid of possible resurgence of inflation because of the tariff threat. We have a government with a policy of tariffs, and tariffs are just taxes. So there's a potential, if these go through, of a massive tax hike, which is the opposite of what we saw after COVID. So this would be a massive tightening of financial conditions. And when you get tariff policy, if it really kicks in the way it might, either prices go up because companies have to charge more for all the extra taxes they're paying on importing goods, or they absorb it themselves and their profit margins get squeezed. But in either event, companies will have a harder time refinancing their debt. And as you mentioned, banks are going to be more reluctant to lend in such a condition.
All right. So the way I set up this next question is I would say that finally, after what seemed like a very long winter here in New England, spring has eventually sprung. Weather's finally getting a little warmer. Everything's starting to bloom. However, if we're discussing the potential for credit contraction, which can be a difficult environment for traditional asset classes like stocks and bonds, I'm guessing you might be referring to the fall season of our seasons of the market chart. So I'm going to turn it over to you.
Exactly. And we try to draw an analogy between the different phases of the market cycle and the seasons, as we know them, winter, spring, summer, and fall. And we find it's a useful analogy. What we do know about the markets is that they always move in cycles. They always have and always will. And there are different phases during the market cycle that the markets keep repeating over and over. And so if you think about in winter, when the markets are in recession, things are down, stimulus kicks in to try to rescue the markets. As we have seen cycle after cycle, stocks rose, and we saw this in the current cycle. And then all the stimulus is often overdone, and eventually the economy begins to overheat, but the stock market is still rising because the trend followers are still following stock market ever higher and causing it to continue to go higher. And we get new records in the stock market like we've seen recently. Then, as the economy continues to overheat, inflation begins to rise, and we've seen that. Gold takes off, in addition, and then the bonds fall because they don't like the fact that inflation and interest rates are rising. So this is what we've seen. It's a typical part of any market cycle. And this can continue until a catalyst comes along to tighten financial conditions. And often that catalyst is the Federal Reserve Board deciding to keep raising rates until inflation falls. And we saw that for a while. Then inflation started to fall. They lowered rates, but inflation really hasn't gone away. So they're in this holding pattern. But what we have now is, with the potential of the tariff threats, we have the U.S. government as the catalyst that, by raising taxes so much, can move us from the summer to the fall. And what we know about the fall season, relating to this analogy, is that then that's a bad time for stocks. It's still not ready for bonds because companies are struggling and corporate bonds don't do so well because credit spreads start to widen. Gold can continue to do well for a period. Cash is king. Cash usually thrives under the fall scenario.
All right, excellent. So my final question then is, after referring to the seasons of the market, which I do think is a great analogy, and touching on how we might enter the fall, how might an investor think about positioning a portfolio to, be prepared for that eventuality should it arise?
Well, first of all, it doesn't have to happen. The serious threat of the tariff and the trade wars can go away. There's a lot of optimism in the market right now that now China and U.S. appear to be getting ready to talk. Both sides are trying to convince the world that it's the other one that wants to talk the most, and that might delay things. But it looks like because tariffs hurt both countries severely, there might be some talk. So maybe this starts to go away, but some of the damage has already been done. It's possible that this stock market bubble, as we refer to it, because the U.S. market is overvalued, it's possible that the bubble continues to inflate if the crowd gets very excited about the prospect of tariffs going away. So we don't recommend being completely out of equities, but within the equities, we do like equities that are buffered, which have some option in them, in the ETFs to try to manage downside risk. We do like, on a relative basis, some of the international equities versus the U.S. because they didn't get so overvalued like the U.S. But beyond the equities, where, as you mentioned, we want to protect against the threat of the tariffs really taking hold, causing a credit crunch, well, we certainly favor U.S. 3-month Treasury bills. That's always a great asset to own during the fall season. There's a shortage of liquidity, as you mentioned, Fritz, and so cash becomes king. And it's also dry powder in case the market continues its slide down to pick up bargains at a much lower price. But in addition, we could have not just a recession, but also inflation, and we call that stagflation. And two asset classes that do really well during a stagflation are TIPS, which are Treasury inflation-protected securities, which are bonds issued by the U.S. government with their full faith and credit backing, but also with a built-in inflation protection. So the higher inflation gets, the more money you make with those bonds. And then also gold. Gold will do well in a stagflation.
Thanks, Steve. And as we know, as we've discussed many times, the future direction of the economy and the capital markets is highly uncertain, and that's why we would say it's best to invest for resilience rather than investing solely by trying to make predictions about what may lie ahead. In the meantime, we will continue to keep our clients and listeners informed about what is happening in the global capital markets under these conditions of radical uncertainty. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone you think might benefit from our weekly videos, please feel free to share them. And if you enjoy the videos, please consider subscribing to our 3Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.